Hello everyone, thanks for taking the time today to join our Q3 webinar covering the AJ Bell MPS service. My name's Matt Brennan. I'm the Head of Investment Management for AJ Bell Investments, and today I'll be giving you a quick run through of what we do, how we've performed, and importantly how we see the world going forward, which is obviously clearly a choppy time at the moment with lots going on. So this quarter actually represented the 5-year birthday of the AJ Bell MPS service. So after originally launching in August 2016, we went through the 5-year point for the passive MPS this time round. We're really pleased to see the service continue to be a success. So AJ Bell Investments as a whole is now managing over 2 billion. For any eagle-eyed watchers, you'll notice that number's going up fairly quickly quarter on quarter. So we're really pleased to see adoption by both direct customers on our UInvest site and also by advisors on our Invest Centre website. We continue to focus on making sure we give you guys a choice. So we have a range of solutions covering obviously MPS, which we'll be covering today. So that's both passive and active, and then growth and income based. We've got our responsible fund and MPS, which we talked around in the last 2 quarters. Until that service is a year old, we won't really focus on the performance there, but it's ticking on nicely in the background, and in particular the fund seems to be gathering AUM very quickly. On top of that, we also have our fund solutions, so that's our passive growth funds and our passive income funds, which really mirror the passive MPS. And then finally, obviously in between our passive and active MPS, we offer our Pactive MPS, which is a blend of the active MPS and our fund solution. So let's get straight to business and focus on the performance numbers. So obviously we'll provide a bit more context as onto the performance as we go on. But I guess what's pleasing to see is positive numbers across the board. So if we start with the passive MPS, we can see a modest amount of positive performance over the quarter. Nowhere near the levels we've seen I guess over the previous few quarters. There's been a bit more of a mix of performance this time around, bonds struggling a bit, and some equity sectors doing well, some equity regions doing well, but definitely some doing badly. So that positive quarter means that there's good sort of 1-year numbers, and as I mentioned, we've now gone through the 5-year points. You can see the 5-year figures we've added there. What I would say on those 1-year numbers, within our FAQs, we do guide on what we describe as an average outcome, but obviously good and bad outcomes. That those 1-year numbers are right towards the top of the good years, which probably highlights how strongly the markets have performed. And as pleased as we are to see that, it is always worth tempering that good years quite often are followed by less good years. So obviously it's always worth being aware that performance has been particularly good, certainly over 1 year after the COVID drawdown, and markets do continue to hit new highs. So it's a similar story on active. So our active solutions have been around not quite as long, but we launched those in February 2018, but now starting to build up a very good track record. Performance in the short term has actually been quite similar to the passive MPS. We'll talk about the drivers behind that. Over the longer term, what we're seeing is in the low risk portfolios, the active is slightly behind the passive. But at the high risk, where performance has been much more differentiated in things like emerging markets, we've seen particularly strong performance from the active solutions. And as you would expect, the Pactive returns sit somewhere in between the active and passive performance, giving you that blend or that marriage of performance or potential alpha, whilst also looking to control the costs. So here we have in a whistle-stop tour really kind of what's happened in the market over the quarter and the year, and what that really means for the way we position our portfolio. So the way we try and do this, or the way we try and visualize this, is, and it's not against everyone, but in general against the market, we're looking at how we're positioned, on different factors, and we compare that to how the markets are positioned. So by markets, I usually mean the IA sectors. And what I'm saying is, if that dial's moving to the green, in general, that's good for us. And if it's moving to the red, often less good for us. So, for example, if we look at the first dial, we tend to be a little bit more internationally diversified than lots of our peers, and that's both in the equity and fixed income element of the portfolio. So we have less UK equities and less UK bonds. What that means, obviously that gives us extra diversification, but what that does mean is how the pound performs can lead to under or outperformance. So if the pound is strengthening, like we saw over the last couple of years, that's a bit of a headwind for us, because obviously the pound strengthening means that your international holdings are falling in value, and then obviously vice versa. So over the longer period, so 1 year plus, we have seen a rebound in the pound following its large fall following Brexit. However, this quarter did see the pound weaken a little bit, so that was a benefit for our returns over the quarter. The next style, we look at our bond positioning. So here we're looking at if we're in long dated bonds or short dated bonds. So we've heavily signposted over the last couple of years our view that we would rather be in short dated bonds, really to protect against the potential of rising rates, which we think could have a fairly catastrophic effect in low risk portfolios, given how well bonds have done over the last decade. There's potential for a reversal if we start seeing yield increases, inflation shocks, central banks changing policy. So that's been pretty neutral over the quarter. Bonds have all just moved down modestly together. Over the 1 year, that position has modestly helped us, but certainly not to the sort of quantum that we think it could potentially happen in the future. The next style is a bit more mixed, and to be honest, against some peers we have more equity weights, and versus other competitors we have less equity weights, but compared to, for example, Vanguard, Life Strategy or something like that, we do tend to be a little bit more heavy in equities compared to those. So when the equity markets are going up relative to bonds, that is good for us, and obviously again vice versa. So we can see it's been a really strong equity market over the last year. Until this quarter, it had also been a very strong bond market, not quite as strong as equities, but as we touched on, this quarter was the first time in a while where we've seen equities go up, bonds go down. So that's relatively helpful for us. On the flip side of that, within the equity markets, we do tend to prefer sort of emerging market equities over some developed markets such as Europe. As we'll touch on, that's really been our biggest headwind, in particular what's happened in China. That has been offset by us having some strong performers in India, but the headwinds in China have hurt. And then finally, we look at our bond positioning, and we have a preference towards credit, so corporate bonds, and in particular high yield bonds compared to having just in government bonds. So again, you can see that's a really helpful for performance over both the quarter and the year. So when you were to look at this slide, you can see that there's some things that have worked for us, some things that have worked against us. In general, it's just tipping towards working for us over the quarter, which is why we see in line or modest outperformance versus the IA sectors. Over the long term, we can see, so the 1 year picture, in particular that DM, the developed market positions worked against us. So for the higher risk portfolios, that's been a bit of a headwind. But again, there's nothing to the extreme that's holding us back. And I think this is good to highlight that this is the importance of having diversified portfolios. Some things will work for you, some things will work against. We really think about these characteristics when we build the portfolios, so we're glad to see it in action and helping us deliver solid returns. So let's put a bit more meat on the bones there. So as mentioned, the equity markets do continue to move higher. Reach new highs in many cases. We've seen the FTSE 100 reach a post-COVID high, if you want to call it that, which has been one of the slower markets to move back up. But as I mentioned, been much more mixed when we look at sectors. So things like consumer cyclicals, basic materials have struggled, and some regions, so in particular emerging markets and China, which we'll touch on, have seen negative performance. You probably it's been hard to miss the story about the I guess energy supply shock, with obviously sort of domestic energy prices surging, and then many of those smaller companies going out of business. But that's not just an issue in the UK. Globally, we've seen obviously the return of demand post-COVID, and then other issues such as logistical issues, supply issues, etc. We've seen strong performance in energy stocks. So again, that was a position. An energy ETF was something we added into the higher risk portfolios, so MPS 4 through to 6 in February. So that's really helping provide a bit of a boost to performance in those higher risk portfolios. We did that because obviously we were looking at making sure we had elements linked to inflation, and there's different types of inflation, but that's certainly that sort of supply shock type inflation is playing out. As I mentioned, the pound has weakened, more short term, but longer term it's shown strong appreciation against what we describe as safe haven currencies. So things like the US dollar, the Japanese yen, the Swiss franc all tend to do well when the markets are nervous, but quite often vice versa. The pound does tend to be pro-cyclical. By that I mean when equity markets are going up, tends to be apart from UK issues aside, tends to show strength in the pound, which again is another reason why we like to have more international holdings, because it's good to have that diversity in currencies as well as asset classes. And then credit spreads continue to tighten. They are really at sort of low levels now. There's probably little scope for further outperformance compared to what we saw earlier, I guess last year. So compared to government bonds, there's a bit of a carry trade. So you'll pick up your extra 1 to 2% yield, but probably little scope for capital appreciation due to further spreads. But that could be famous last words. So I'm not promising anything. So a bit of a whistle-stop tour around the world. So Japan struggled last quarter. We've seen that bounce back this quarter to be the best performing sort of major country or region. It's recently obviously elected a new prime minister, and that's given hope to the market, as I say, following what was struggles earlier in the year. The US, the UK, somewhere in the middle, and even Europe, not too far behind. But as mentioned, it's that kind of EM and Asia region that's seen struggles. China was down about 16–17% over the quarter. Actually, on the other side, India was actually up about 15%. So a very mixed bag in that region. But as China looks to regulate things like the technology sector, that's definitely caused growing pains in that region. Ryan Hughes, the head of research at AJ Bell, recently produced an article on InfoCenter around China and our longer term views, that we actually think in the longer term that will be helpful. So I'd urge you to go and take a look at that. But it certainly has caused us issues in the short term. But again, it's important to focus that we're not really heavy into China, just a little bit more than some of our competitors who often favour European equities. So it's just given us a little bit of a handicap on performance, but that has been offset by other good things that have been working in the portfolio. So as well as regions, another thing that tends to drive the market is styles and factors. So a bit less of a guess, a sort of range here. So the best performing style versus the worst performing style, about 3% in it, which is not too much really compared to what we've seen in other quarters. Here we're looking at the MSCI World factor indices. So these are sector and country neutral, but instead they focus on targeting each style within there. So really, momentum growth stocks led the way. But actually, even if you look at value stocks, although not quite as good a quarter, not too far behind. And as we touched on, it was really almost like a barbell effect in value this time. So some value stocks actually did really well, whereas certain sectors did less well. Although I guess what is worth noting here is as high dividend did struggle a little bit. So again, we were pleased to see our income portfolios do relatively well, and small cap did less well after seeing really strong performance over the last 18 months. So we'll just cut the equity world one more way, which is across those sectors. So as I touched on, things like energy did particularly well. But again, as well as energy, the other end of the scale, technology had a reasonably solid quarter. However, at the other end of the scale, things like consumer cyclicals, so things like discretionary companies, and then obviously mining companies did less well. So as you know, we use different sectors in our portfolios, more for diversification purposes, really. But for example, we use a combination of energy, technologies, utilities, healthcare, consumers defensive, and consumer discretionary or cyclical. So we've really got a range of sector performance there, but that again stops us being caught by having unintentional biases within the portfolio. And then, as I mentioned, bonds in general were down somewhere between 0.5% and just over 1%. You can see those longer dated bonds down by slightly more, but it was no means really performance driving. Only 0.5% between the best performing maturity bucket and the worst performing maturity bucket. So it was good to be slightly shorter duration over the quarter, but not really a big performance driver. So let's focus on the deliverers of return in the actual portfolio. So if we start, I guess, in general, talking about the active and passive growth range. So as I mentioned, positive performance across the board. Passive and active performance was pretty similar. As I say, there was, as we talk about, for example, active tends to do well if value is doing particularly well, or if there's really strong small cap performance. We didn't see a quarter like that, so kind of pretty similar performance. In the active side, at the higher risk portfolios, we did see some fairly decent performance, as we were able to have some defensive emerging market positioning, avoiding some of the worst of the falls in China. We've got that shorter maturity, shorter duration position. It helped, but only a little bit. But our position in riskier bonds, such as high yield bonds, did help. But we do acknowledge that they are linked to equity and have performed pretty well. So it's an area that, as we go into our strategic review at the turn of the year, that we'll certainly consider future potential returns there, and there's a chance that you may see reductions in those areas. And then, as I mentioned, not all the sectors did well we used, but in general, more did well than badly. But more importantly, they do add that extra layer of diversification to capture different things happening in the market at different times, such as energy supply shocks, for example. So obviously on the passive side, we use ETFs. So probably little value in talking about those particular ETFs. It's really that macro side that's driving performance. But we'll just pick out a couple of the active sort of winners and losers. So as I mentioned, on the winning side, in EM, things like the JP Morgan EM Income Fund, which we use, did protect against some of those falls in China, more defensively positioned, and positioned towards India, for example. Within infrastructure, again, we saw an interesting quarter for infrastructure, given that focus on sort of utilities and energy companies and renewables even. So that performed again well in absolute terms, but also against its benchmark, it did well. And then, as I mentioned before, small companies actually didn't do too well over the quarter in relative terms. So it was really good to see the Artemis smaller companies booking that trend and delivering decent performance. You know, it's a team that we like. On the other hand, we had a couple of detractors. So where we have global exposure in our asset allocation, so be that healthcare or technology, some of the active positions we use have a bit more of an EM bias, so they've been left behind. So two I've pulled out here are the Worldwide Healthcare Trust and Polar Cap. You know, two positions that have worked well in the longer term, in particular Polar Cap, but have provided short-term headwinds. And then similar 91 Alpha in the UK, due to the way it's positioned in different sectors, which is, you know, as we showed earlier, there's been a decent range of performance, and has left this one a little bit behind. So moving on to the income ranges. So again, the way we look at this is the income one portfolios have got broadly the same asset allocation as MPS 3, and income 2 is broadly the same as MPS 5. So comparing performance to those, you can see the passives were in line. The active ones actually slightly outperformed, which is good to see after, you know, struggling relative to those growth ranges as dividends fell last year, but we are seeing a recovery. On the passive side, the ETFs we use, lots of them are sector neutral, so they're not able to benefit from particular sectors doing much better, like energy, whereas active managers, you know, they're able to be a bit more nimble, and that's been the benefit over the quarter. And then, as mentioned previously, the MPS, the income one used to be more similar to the MPS 2, but we brought it closer to the MPS 3, which means we've reduced the bond exposure. Obviously, on the surface, that increases the risk, but as I've outlined, given bonds have actually delivered negative performance, that's helped returns over the quarter. The reason we did that was lower and lower yields available from bonds, so instead we prefer to get diversification and target that yield through equities. So what does that mean, you know, in terms of what we're thinking going forward? So the market has really been struggling to make their minds up. You know, every single webinar you go on to, there'll be debates around inflation. Is it transitory? Is it long term? So yeah, I think the inflation debate is one, and then obviously the other thing on people's minds at the moment is China. After seeing really strong performance for the last few years, it's struggled. You know, and there's also, as well as the regulatory side, you know, there's a growing focus on things like human rights and some of its practice in that region. So on the inflation side, we've made sure we have really thought about designing the portfolios to make sure there's elements that will protect against rising inflation. So that could be equity sectors such as energy and utilities. It could be our positioning towards things like absolute return and infrastructure. And then obviously in the bonds, we do have some treasury inflation protected securities or TIPS, but more importantly, we think just having that shorter maturity stance, it doesn't deliver outperformance, but it protects in terms of any market falls if bond yields rise in line with inflation. On the China side, it's an area that we're investigating closely. As I say, we have a modest overweight to the region. You know, nothing sort of significant. We've got some good managers in those regions, but as you say, it's an area that, you know, as it comes more into focus, it's something we consider to continue to focus on and make sure we've got the right weights there to balance the potential for higher returns in that region in the long term, alongside the risks that region faces. 1 year returns are at the top of our estimates, so as I mentioned, you know, kind of temper future expectations. We've seen a catch up between value and growth over the last 18 months. You know, that tempered this quarter, but there does still seem to sit a valuation gap. If you look at the difference between the valuations on value stocks and growth stocks, are still historically wide. So, you know, again, it's something that could pick up steam again, in particular if the inflation story plays through. And then, as mentioned a couple of times, we are in the process of updating our strategic asset allocation into the new year. So we take, you know, as well as taking a long-term view, we do try and consider some of these shorter-term issues in those. So that kind of changing global investment landscape means that we'll continue to think about the spectrum of inflation, and probably most importantly, going into the next year is making sure you're well diversified and actually ready to act quickly if required, because things are changing quickly. It's really hard to stay on top of everything, given how quickly things are changing, but we always do remain able and willing to change the portfolios if required. So I'd urge you to continue to keep up to date with what we're doing. We have updated our quarterly reports recently to hopefully make them a bit more user-friendly, a bit more graphical, shorter, snappier, but hopefully more useful for both yourself and for when you're speaking to your clients. So thank you very much for taking the time today to listen to this webinar. Hopefully it was useful. You know, if you do have any follow-up queries, just drop us a line, and thank you very much, and speak to you all again shortly.